And I was working very hard to avoid going back into insurance, and I just couldn't let the problem go. And recently had a couple of challenges in healthcare. A friend that was very badly impacted, in my opinion, due to a $200 healthcare choice that he deferred because he was trying to make his student books payment, and ultimately it cost him his life. In terms of the value proposition, what makes us different, our goal is to bring humanity to health insurance. There are just too many very sad stories that occur. Everyone has a friend or family member who's been through one, mainly because it's a very large system in healthcare with very badly misaligned incentives. So there's a lot of delays in healthcare, a lot of duplications in healthcare, a lot of extra expense. And so we're very focused at putting a human in the loop, make sure that we do everything we can to get people care sooner and of higher quality. We want healthcare to be as easy as ordering a pizza. And to that end, everything from our benefit plan design to how we contract with the physicians and hospitals, to the software we use to improve the user experience, all of that is designed to try to eliminate barriers to care. So whether those barriers are economic, even $100 can make a difference for some people, or it's time. You're simply so busy you can't get across town at 7 p.m. and you need an answer now about whether or not something is urgent for your child. So, in the first instance, economic, we make sure we kind of led the nation in bringing back a $0 deductible health plans and trying to minimize any financial barriers to access to care. So very, very rich plan designs. And in the latter case, in terms of time, we've prioritized digital health and telemedicine and make those free. So we have a very large group of digital solutions, but we also have 24/7 free pediatric telehealth, 24/7 free telemedicine with physicians, including mental health and behavioral health specialist physicians.
The help that we can give her, I think she's progressing beautifully, wonderful.
And that's how we address it. That's what makes us different ultimately. It's higher quality benefits, faster access to service, and we really try to put a human in the loop.
You've been listening to Chris Gay, entrepreneur and co-founder of Every Health. Chris started his career at Goldman Sachs, but quickly pivoted to his first entrepreneurial venture, MileMeter. That first venture was in the automobile insurance space. After that, he spent time with a venture capital firm, but then began to think about health insurance. As he said to me, quote, "I wanted to create a firm whose plans were right for my family, plans that wouldn't force people to make risky financial decisions like one of my friends did, a decision which cost him his life." So Chris and soon his co-founders Jay and Mark created a business plan for a new kind of health insurance business, one that was technology-driven, but at its core, one whose goal is, and I quote, "to bring humanity to health insurance." Imagine that. Join me in my conversation with Chris as he takes us on his entrepreneurial journey from idea to funding through Y Combinator in California, to nearly failing in the process of scaling, to today fully funded. And then listen as Chris offers us an inside baseball look at the health insurance industry. It's eye-opening. I'm your host, Mark Good, and this is Remarkable, a podcast focused on people and stories worthy of your attention. And now, today's show. I want to welcome our guest, Chris Gay, today to another episode of my Remarkable podcast. Chris, please, for the many people who don't know you, please introduce yourself.
Hi, thanks for having me, Mark. Chris Gay, and I'm based in Dallas, Texas right now, and I currently am the CEO and co-founder of Every Health, which was recently acquired by Globe Life.
So that's marvelous. Well, tell us a little bit about your professional background, because you've talked about being an entrepreneur for 25 years. Let's roll the tape backwards. Give us a thumbnail overview of your professional background.
Well, like many people coming out of university, I ended up in the finance world. So I went to work for a division of Goldman Sachs. That didn't last very long. I was not a good fit for that organization. And then I ended up in the software world. I kind of did a lateral transfer in the Goldman hierarchy at the division we were in, from portfolio analysis over to the IT team, partially because I realized that much of Goldman back then, you're talking mid 90s, ran on spreadsheets and VBA, lots of VBA macros. We were mostly Excel spreadsheets. There were still some Lotus spreadsheets floating around, and a big Oracle data warehouse behind it. So I made friends on the IT team, and they didn't have to wear suits. I did a lateral transfer and learned how to program. And from there, I joined a .com startup. I had terrible timing. That's right before the bust of the .coms, and I mostly worked on things around content management for Belo. Belo was a very large media organization at the time, owned like 27 television and newspaper and radio properties. And so we had a content management system written in Java that I was a young programmer on. And then I ended up in a bunch of defense consulting. Family business was defense consulting startups. So then insurance. Took a wild hair left turn and founded Mile Meter in the mid 2000s. We created auto insurance by the mile, or pay per mile. We're the reason you get asked about your odometer mileage on your car. Particularly proud of that one. With my colleagues and investors, we lowered insurance premiums 50%, and especially benefited women and low-income households who were being taken advantage of. After that, spent some time on the other side in a small venture capital shop and a mid-level venture role. Then led a turnaround of one of our portfolio companies, because in venture, not all of your companies do well. Sometimes you get the shortest straw, and you have to jump into an operating role and help move a portfolio company to profitability. From there, I went to work for Murgatroyd of Scotland in London, who had acquired the portfolio company. And then after that, I started Every Health. So Every Health is the healthcare I wanted for myself and my friends and my family. And I have two co-founders there, Mark and Jay. And we founded that back in 2017.
I think that's when I first met you, when we were at the shared workspace there in Dallas. I think it was called at the time Top Desk. Is that correct?
That is. You've got a good memory. I don't think we'd even started Every Health back then. I think I just finished rolling off of a consulting role, and I was looking for the next thing. What am I going to do next with my time that's interesting? And I was looking to go back to the corporate world, quite unsuccessfully, I might add. I'd finished up an MBA, and I was thinking of going back to the corporate world, and I just was not very successful at that. I had the good fortune of meeting Jay there, a fellow co-founder, and same time, you, I, and Jay were all there in that space at Top Desk. So,
well, tell me, you've talked about Every is the healthcare company or the health insurance company you wanted for yourself. Knowing you as I do, that you're a very thoughtful person who does a ferocious amount of research. I've seen you working there at Top Desk, head down on your Mac laptop, just drilling down deep. Health insurance is a mind-bendingly complex marketplace. Why would you say, I want to go into healthcare? I mean, what was not only the compelling reason why, but what's the compelling value proposition that makes Every healthcare different than all the rest of them out there that many of us know about?
In terms of the value proposition, what makes us different, our goal is to bring humanity to health insurance. There are just too many very sad stories that occur. Everyone has a friend or family member who's been through one, mainly because it's a very large system in healthcare with very badly misaligned incentives. So there's a lot of delays in healthcare, a lot of duplications in healthcare, a lot of extra expense. And so we're very focused at putting a human in the loop, make sure that we do everything we can to get people care sooner and of higher quality. We want healthcare to be as easy as ordering a pizza. And to that end, everything from our benefit plan design to how we contract with the physicians and hospitals to the software we use to improve user experience, all of that is designed to try to eliminate barriers to care. So whether those barriers are economic, even $100 can make a difference for some people, or it's time. You're simply so busy you can't get across town at 7 p.m. and you need an answer now about whether or not something is urgent for your child. So, in the first instance, economic, we make sure we kind of led the nation in bringing back $0 deductible health plans and trying to minimize any financial barriers to access to care. So very, very rich plan designs. And in the latter case, in terms of time, we've prioritized digital health and telemedicine and make those free. So we have a very large group of digital solutions, but we also have 24/7 free pediatric telehealth, 24/7 free telemedicine with physicians, including mental health and behavioral health specialist physicians. And that's how we address it. That's what makes us different ultimately. It's higher quality benefits, faster access to service, and we really try to put a human in the loop. But that kind of begs your other question, like, why would we want to own a health insurer?
Well,
what was wrong with us?
Yeah, no, that's it's very interesting. You've shared a lot of things that I want to drill down on in a minute. But first, just sort of in the order of battle here, you have a compelling idea. Then you meet a co-founder, Jay, at Top Desk, right? I got many fond memories, and as Jay probably knows, photographs of Jay, because I was always dragging my camera around with me. But you have another co-founder, Mark. How did you sort of build that team? How did you, kind of coalesce as a team? How did you make those decisions as the founder?
Well, in the beginning was me, and as you know, the challenge in building a company is always finding. You're basically growing a community. We call it a team. Right now, what we're saying, but you're building a community that's much broader than that. All along the way, you're trying to find people that will challenge you, but agree with the overall principle and direction, right? That, hey, that's the right solution, or that's maybe they don't even agree with the solution. They agree it's the problem worth spending years on or spending time on. And that's the hardest challenge, is finding people that want to spend their time. And you find team members, and we can get into detail on that, but it's also finding other people that aren't necessarily team members, but also want to work on the problem or are willing to help or lend their reputation. So friends and vendors and advisors and investors and channel partners and distributors, customers. And all along the way, when that happens, as you're building momentum and you're gaining resources, and eventually you have enough resources to make an impact on a very large healthcare system. And so in the case of Jay specifically, it was just me. And I was working very hard to avoid going back into insurance, and I just couldn't let the problem go. And recently had a couple of challenges in healthcare. A friend that was very badly impacted, in my opinion, due to a $200 healthcare choice that he deferred because he was trying to make his student books payment, and ultimately it cost him his life.
Wow.
And I met Jay when we were at Top Desk. I was just doing a lot of research on it, and Jay had a fantastic analytical mind and just enjoyed talking about it. And he also had experience in a fintech startup, a very impressive fintech startup he built. So he understood regulated financial technology. And before that, he'd been in healthcare on the private equity side. So he actually had a great generalist background. We just got along real well. And so I think that was key. You're going to be working on something for years. You want to get along well with people that have some shared experience, agree with the issue. He had also wanted to go after this problem because he had a family member have a very sad outcome that he, in hindsight, believes was preventable. So that's how Jay and I hooked up, and we got to meet and become founders. And then the third one, Mark, having done this before, I'd done an insurance company before at Milemeter. Healthcare and health insurance is about 10 times, and I don't say that lightly, it's about 10 times more complex than property and casualty insurance. And so this time I knew I needed to have an actuary, a healthcare actuary, as part of the core founding team. And I called up a good friend I'd known from Milemeter. His name is Jack. And I called him up on the East Coast and said, we're thinking about going into healthcare and health insurance. Do you know any actuaries that might be interested in getting involved? And they need to have a sense of humor. And he laughed on his side, said, well, that's a pretty short list. But let me talk to some people. And sure enough, a few weeks later, he called me up and said, hey, here's two people I want you to meet. One of them was Mark, and we hit it off immediately. And that's how I got introduced to Mark, and Mark became a co-founder. It took a while before we got to meet him in person, but.
So you were doing kind of remote, I don't want to say work from home, but remote connectivity long before COVID, long before it was the thing, with a co-founder, correct?
Correct. Yes. We'd been virtual from the beginning in 2017, and most of us had time working remotely or on virtual teams and consulting. But the nice thing about consulting is, while you may be virtual, you typically meet your colleagues and the clients at the client site, often for days or weeks at a time. It's much more challenging if you're purely virtual. You have to force some time together. In our case, that happened when we come together at Top Desk, and you saw us in the early days. And then when we were admitted to Y Combinator, then we spent 5 months in very close proximity, cooking and cleaning that condominium together while we worked to build the company up.
So let's talk about that, because I do remember the early days when it was just you and Jay. I remember hearing about Mark. And then I remember you talking about Y Combinator, and that's before Y Combinator, at least in my mind, had the visibility that it does today, I guess courtesy of Sam Altman. Tell me why you chose Y Combinator, what that process was like to get in there, and then talk a little bit about what it was like to be there, as you put it, in that condominium with your co-founders.
Yeah. I never planned to go through Y Combinator. We never did. Given the successes we'd had previously in our careers, we expected to raise 10 or 20 million pretty quickly from VCs or potentially even private equity to found the business. And we had gone down that process for several months unsuccessfully. Couldn't get people to invest. And we were close to shutting it down, walking away and go take consulting jobs, go back to the corporate world. And actually, it's Jay, if I recall correctly, it was Jay who insisted we try Y Combinator. And so I remember we applied. That was controversial in its own right, because we had a fourth co-founder at that point who did not want to do it. And we kind of dragged him through the process like, this will be a good thing. It's not what the way we wanted to go forward, but there is value here. Let's just accept the process and give it a try. And we put together the application. And at that time, Y Combinator had a particular call for proposals or call for startups addressing healthcare in the United States. Then we got an email back that we'd been selected for an interview, and we showed up for the interview. The interview was all virtual. It was kind of awkward because the partner interviewing us was in silhouette, I guess in his attic. It seemed very informal. It only lasted like 15 minutes. Lots of rapid fire questions, and that was it. And then we got another email saying, congratulations, we'd like you to come out to California, Mountain View, and meet the partners for a final interview. We all flew out there, and you show up. There's mass of people in the hallways. They're all rehearsing, practicing, lots of nervous people from all over the world. It's like a frenetic college hallway. And then there was us. We were about 20 years older than most people there. And we finally, it's our time to go in a room, and there were 3 Y Combinator people on the other side of a desk, and 4 of us. And at almost the entire 10 to 15 minutes, there were 3 conversations happening at the same time. And they would cross-talk and cross over each other. And then you leave and you wait. And I think we got the phone call a couple hours later. We were on the metro. I think we were on the metro train, and I got the phone call saying, you've been accepted. You have a period of time to confirm, or you have to confirm on the spot. I don't even remember if we had to confirm on the spot. And that was it. And we had to move out there, and we lived out in Sunnyvale, California, on the border to Mountain View for 5 months in a tiny little condo. We did all the cooking, all the cleaning, and we had to grow the company and establish milestones while living off of a total of $120,000 for all that time period. It was
Yeah,
extreme.
I think most people don't realize it's a residential program. It's like being admitted into a college or a university for a semester. Would that be a fair statement?
It is. That's a very fair statement. I think there's a lot of value to being there in person. Since then, they've had a few classes that are fully virtual, but we had the privilege of being one of the smaller groups, class groups, and it was in person. I liked it personally. I found value in being in person. You're meeting a lot of other fantastic entrepreneurs from around the world, which I thought was one of the greatest parts of the program. I didn't like living jammed in a tiny little condo. That that was hard to do. I think our rent was like $5,000 a month, and that was the cheapest thing we could find that we could jam all four of us into. And when we first got there, it turned out whoever was leasing it to us was basically a hoarder. And so we showed up, and the place was a disaster. We lasted about 6 hours, and then we broke. We just started cleaning the place. I think we threw out 3 dumpster loads of stuff, and we cleaned the place top to bottom, down to the point we were like scrubbing the bathroom with a toothbrush, because the alternative, we couldn't find another place to live in the time period. So we cleaned it. So we're a pretty good cleaning crew.
Yeah, right. So you said that, it's interesting because as you pointed out before you applied to Y Combinator, you had this working assumption that given the background of the founding team, that you could go raise $10 to $20 million and be off and running, which is a reasonable sort of assumption to make given your careers and your experiences and your successes. You didn't have that success. And so you pivoted, you go to Y Combinator, but you're one of the, as you said, the older teams. What are some of the positives? I mean, apart from meeting other entrepreneurs, wasn't there or isn't there an expectation that if you get accepted into Y Combinator, apart from the $120K that kind of pays you for the 5 months, isn't it that you're sort of pre-positioned to make a capital pitch to investors there? Is that correct?
That's correct. And we weren't the oldest. I think the oldest team, there were people that were older than us, but we all kind of joked we were the affirmative action hires to bring up the average age substantially. The Y Combinator has, in my experience, 2 great benefits. One is meeting all those other entrepreneurs. The challenge is you just don't have enough time to talk to them all and really get to know them. So the depth of the relationship is relatively shallow, except for the people that are in your cohort and in your, think of it as your study group. You get to spend a little more time with them. The other big benefit of Y Combinator is, in my experience, multiple startups and being on the other side of the table, I've never seen anything like YC's funding platform for founders. The power and the market leverage is on the startup side, not the investor side. And so you go through the program. I mean, I've never seen anything like it. And they tell you to trust them. Don't try to raise money. Wait till demo day. Just keep your head down, build the business. Head down, build the business. And along the way, we were getting pinged by some really prestigious investors. And our group partner said, just keep your head down. You want to have coffee, that's nice, but build the business. Which is challenging to do when your primary need is capital. Like, you know how to build a business, you've got the experience, you just need capital. But we kept our head down, and we go to demo day, and you are in front of, these days, I don't know what the number is. It might be closer to 4,000 to 6,000. At our time, when we presented in 2017, 2018, I think it was something on the order of 2,000 to 3,000 investors that you're pitching to simultaneously.
Wow.
And in person, you were in the museum, the Computer Science Museum there in Palo Alto, and there's maybe 400 to 600 investors in person, and the rest were all on a virtual platform. So you've got family offices and funds and angels all over the world tuned in, watching what you're doing for a 2-minute pitch, and then after that they can reach out to you, ping you, say, hey, it's interesting. Or they might just say, hey, I'm not interested, but that was a great pitch and I applaud what you're doing. Sometimes they just give you affirmative support, but then you start the process of feedback. So that's the two big assets in my experience with Y Combinator, where the other entrepreneurs and the capital raising market I've never seen anything like it. For early stage capital, it's impressive.
Did you say 2-minute pitch?
Yes, you got 2 minutes. When we did it, they had pruned it down to 2 minutes. Our class, I think we had roughly 150 companies in our class, which is one of the first classes that was pretty large. Then they got up to the point they were doing much larger class groups than that, particularly during the virtual pitches, and they've pruned it back since then. But 150 or so companies, you don't have time for 5-minute pitches. And so you would rehearse and rehearse and rehearse. What are the key things that you need to get across in 2 minutes? It was very straightforward. Tied to that is you can't convey everything. So what's the real purpose of a 2-minute pitch? The real purpose of a 2-minute pitch is to establish interest and get the next conversation. That's it.
That's exactly right. Yeah.
I mean, you're not going to go into market strategy and product differentiation. No, it's, hey, here's the problem. We've made a little bit of headway towards it. Here's the team that's going to go after it. And, we want 2 million to do the following things. We're in the orange shirts. You can find us in the back or reach out to us online. Thanks. That's pretty much your pitch. A little class. I still have it someplace here. But that's what you do, 2 minutes.
So tell me what happened. You made your 2-minute pitch, knowing you snagged some interest. Tell me what happened after that.
Well, after that, we asked for $2 million. I still remember it was $2 million on a 12 cap. And it was nerve-wracking because we didn't have enough money to, I think, make it another 30 days. We're going to have to go back to our day jobs unless some money came in. We needed some money. So it was very nerve-wracking. And we walked off the stage. My knees almost buckled when I was giving. It was like being married all over again. You had to remember to breathe and keep your knees soft. Afterwards, you go to a larger conference room there, and we were all wearing orange t-shirts, bright orange t-shirts to get attention. And someone came over, introduced themselves, but they came over and they were nice, asked a couple questions, and then said, hey, I'd like to invest $200,000.
Wow.
Then we agreed, and yeah, we'd love to have you. And you shake hands on it, and we'll send over a confirmation email, a handshake agreement for $200,000, which is how YC works at a 12 cap. And then we'll email you the safe notes. That we'd use safes as a simple agreement for future equity is the financing instrument we'd use. And that started. And I think the next person after that was $100,000. And then, eventually you get some bigger checks, bigger people, and some people reach out and invite you to meetings in town. And so you go and have coffee meetings or equivalent all over the valley. And eventually we raised, I think, $2.1 million.
Now, were you able to break escrow before you reached 2 million?
Yeah, that was one of the nice things about the SAFE is it's a rolling deal. And in the YC community, they've cultivated investors that understand the seed stage startup, that we're not doing a priced round where you get all these commitments and then 90 days later you call everyone up and say, hey, we're going to close next week. Everyone get your money in. In the meantime, the startup has no cash. The YC community is very accepting of what you and I would probably call a rolling funding, particularly using these safe instruments, which was very, very, very helpful. And so, I think in our first week we had $500,000, and then everyone's blood pressure went down. Hey, we can make some plans. We got lots of other meetings booked up. Let's just work down the list and say hello to everyone that wanted to say hello. And eventually it was a successful capital raise. Some people were much more fortunate than us. We ended up, I think, with something just under 40 investors, which was actually a pretty hard raise. I had colleagues and friends that had 2 to 5 million in 2 meetings. They were just,
wow.
They were very popular and sought after, and it was easy for them to raise. So it just kind of depends. Everyone's path is a little different.
So you got your 2 million, and I can remember again from the Top Desk days that was the number. I remember you sharing that with us to say, we're going to go to Y Combinator. We're looking for $2 million. So relative to your business plan and your model, what were you committing to your investors that you could accomplish on 2 million? Because you're starting an insurance company, a health insurance company. And I mean,
Yeah.
2 million, honestly, that it sounds like a lot to people who aren't familiar with venture capital or fundraising, but that's honestly not a lot of money for what you were trying to do.
It wasn't, but it's what we were told the market would bear. You have to keep in mind a little bit of context. 2017, a lot of the United States was very frustrated with the Affordable Care Act. And believe it or not, there were a lot of investors that flat out would not invest in U.S. health insurance. Just wouldn't do it for a lot of reasons. One, they were concerned about government interference. Two, they were concerned about margin compression. It was just a tough market out there. And it was the political cycle heading into 2018 and 2019, there was a lot of talk about single payer, which spooked a lot of people.
Yep.
I believe it was unwarranted, but it spooked a lot of people. In our opinion, we lost one term sheet because of that. However, 2 million, back to your point, it's not a lot of money. So with 2 million, our plan was at the time, we were going to partner with a super regional health plan that we were going to leverage their license and their brand, effectively a fronting arrangement. So I didn't need all of the balance sheet and surplus and capital reserves. I just needed enough to pull together the sales team and technology to land a few small clients, and then you raise the next big round of capital. That's it.
Right.
Typically, you're raising capital for a 2-year run at a seed stage. You want enough that if you keep it lean, you can survive for 2 years, which we ended up doing. However, to your point, it all went pear-shaped very quickly. We'd worked so hard. We'd raised this money. We had a clear path to, in our view, a very clear path to success. And we had shaken hands on a deal. We had a verbal contract, and we were inking the deal. We were down to terms, and lawyers were going back and forth with the super regional health plan, and then they broke the deal in bad faith.
Wow.
It was really damaging, and we decided not to sue them at the time, although we probably could have won the lawsuit, but that changed everything. So that caused a lot of problems on our end and forced us to then cast about, well, now $2 million only works if we have a fronting partner. So we tried to go find other fronting partners to unsuccessfully. We talked and called and met with many companies across the country. And ultimately, out of exasperation and a belief that somehow this will work out, okay, we didn't want to do this, but we're going to chart our own insurance carrier, which basically meant you need an extra 2 years. We're going to have to take the slow road. We're not going to get the fast road. We're going to take the slow road, and everything is slowed down. So we had to trim everything down, survive on as little money as possible. And eventually what happened is in 2021, we finally got all the licenses approved by the Texas Department of Insurance. I mean, you think about that. We basically had lived on 2.3 million, 2.1 to 2.3 million from late 2017 until early 2021. Jay, Mark, and I, at one point, I think we'd gone without paychecks for 2 years. We were picking up, work as consultants or odd jobs. One point, I had 3 jobs to pay the bills. But along the way, we knew it was moving forward. It was going through the regulatory gates. We were trying to raise capital. I kept meeting with people, but until you had a demonstrable milestone, to a lot of people, we just looked like a dead company that wouldn't admit it was dead. You have no revenue, you have no customers. That's nice. You built some technology. That's nice. You're smart people and experienced, but you have no path to market, was the pessimist viewpoint. You'd argue, well, it's the other end. We're about to get a license. This is a big deal. That's a very long process. It's a huge asset. But raising capital was just not going to happen. It was a bunch of no's until we got the license. And then once we got the license, someone stepped up and wrote a big check. And then others came alongside them. And we were able to fund the company, basically rebuild the team and get things moving. And from 2021 forward, we've been very busy. I don't recommend the path we took. It was a long path. You can avoid it. Take a faster way to the end. It was not pleasant.
Well, Chris, even though we relocated Dallas to Northeast Ohio, Shaker Heights, we did keep in contact sporadically during that time. And my wife Pam would ask me, "How's Chris doing?" And I would check your website, and my metric was, if the website is still up, I know Chris. That means you're still trying to get the capital, or you're operational. I didn't know, and we talked a couple times. But so I have to ask you, because you have been living in the health insurance industry now for years as a startup, now as a funded entity. For people who, I'm a consumer of health insurance, and I'm at the age in life when I have Medicare, so in a sort of supplemental plan. And for me, life is good. There are a lot of people listening to this who are younger who would bemoan the fact that the government pays for Medicare, but for me, it's like a single payer system. Tell me what you have observed. You mentioned this a little bit earlier about what's wrong with U.S. health insurance, the healthcare system. I guess would be I know that's a big ask, but what are
That's a big one. We're going to be here a long time. But is there a particular part of the healthcare system, or just broadly?
I think a lot of people have this view, and I've had this view. And if you disabuse me of this notion, tell me. But there's a lot of people that view the health insurance community, right, between the patient who is in need of care and the healthcare provider who's providing care. They view that insurance system, process, and companies as being burdensome, complex. I don't mean to be offensive, but greedy. I mean,
you're not going to offend me.
And
We're
a
friends.
barrier to.
I've heard it all.
Yeah, but I mean, there's a lot of people who say if we would just, short of a single payer system, such as what I'm experiencing now at this time of my life, how can health insurance work and not be what it has been for so many people?
Well, we can have a rambling dialogue here then. Well, big picture, in the United States, we actually have quite a bit of excellent government, what I would call single payer or nationalized systems. You've experienced one in Medicare. No system is perfect, but Medicare, in my opinion, is pretty well run. Another one is TRICARE. So TRICARE is basically single payer government health care that's administered by private companies like Centene or United or whomever it may be. The government pays them to administrate it, but it's single payer. Then you have wholly owned government systems of healthcare. One is the VA, Veterans Affairs. The other is Department of Defense and Health Services. So all of our service members internationally and nationally and their dependents, their spouses and children, get nationalized health care. It's what I had as a child growing up. It was quite good. You didn't get to pick your doctor, or you didn't get to pick your hospital, but everyone got the preventative care they needed. And whether your family was wealthy and a flag officer, or your family was young, private first class family, everyone got equal access to care. We do in the United States have a long history of excellent single payer and nationalized healthcare programs. However, the majority of Americans get their health care through their employer-sponsored health plan. It's what we call commercial large group health. And so that's where my company operates. It's where the majority of Americans get their health care, and that's where we want to have the most impact. If you're going to go solve a problem, try to help the most people. And so that's where we're at. In terms of your other question, issues with healthcare and the perception of health insurance specifically. So for us, like part of the reason I want to be in health insurance, I didn't want to be in health insurance, but the catch is health insurers control the data. And health insurers also, as middlemen, are ideally positioned to influence communications, technology choices, and financial incentives. But those are all kind of meaningless unless you control the data. And so while we're a technology company that happens to own an insurance company, the reason we do that is because you got to have the data. And as a middleman, you want to be able to make all those little user experience choices and financial incentive choices to kind of herd a population in the right direction. The challenge that people have with insurers is many of them had bad experiences, and insurers are easy. Doesn't mean I agree with existing legacy insurers, but insurers are easy targets politically. But they're only one part of the system. Part of the reason, in my experience, that they get roasted and maligned is because they're doing in many ways the job of government. Insurers are acting to set policy and enforce policy, oftentimes where there is no government body that is actively managing it. So in any community or industry, you have bad actors. No matter how well educated they are, there are bad actors. There are people that will be criminal, that will take advantage of a system. You also have, on the other end, you have people that are just overusers. We all have people, that they want 3 cookies instead of 1 cookie. And
right.
When you're talking at the scale of U.S. healthcare, that adds up. If people have a lot of what we'd consider indulgent healthcare or overutilization of healthcare or misutilization of healthcare, even if it's legal and permissive, that takes away from other people in the community if we're all paying for it. So whether it's your employer-sponsored health plan or it's a nationalized system like Medicare, the job of the insurer is to look at all of the community health needs and say, hey, this is what you need. We need this many financial resources to accommodate you, whatever that is, X, and we're going to price it for everyone assuming X. When you have people through fraud, waste, or abuse, those may not be individuals. Those may be entire medical systems doing the fraud, waste, abuse, but it can also be individuals. It can be physicians. It can be facilities. It can be other counterparties. Someone has to have the policy so you can identify it, the abuse. They have to have an enforcement mechanism to document it and audit it. And then you actually have to have some way of dealing with it. And insurers do that. And if they don't do that, what happens is the cost is no longer X. The cost is X plus a lot of percent. And we're all paying for it. So whether it's employer-sponsored healthcare or Medicare or you're in Medicaid, it's a population. And insurers in many ways are acting as policy agents and police. It's not a fun part of the job, but it's a necessary part of the job. And I think it's why they get a lot of criticism.
Okay, so at the beginning of our conversation, you talked about your motive for getting into healthcare and the things that drive you. You have this wonderful expression of it's the health insurance I've always wanted to have. You talk about these tragic stories of people, that for $100, $200, things went terribly wrong. Maybe they suffered a serious health calamity or lost their lives. And yet, people listening to this podcast go, I understand that motivation, but there's an arbitrage here because you're able to raise money from capital sources that have an expectation that you will provide a greater than market level return on their investment, right? It's a venture investment.
Yes.
And therefore, what's kind of so to somebody listening to this is one of those things where somebody might say, well, Chris, how can you provide this superior health insurance product at a lower price? I mean, you've talked about zero deductible, which is incredible, and still provide a greater than market level return for an investor. How does that work?
Sure. There's 2 questions in there. One, how can we provide a superior product at a compelling price? And, is it a bait and switch, right? Or are you going to get hit with a huge renewal up rate a year from now because we underpriced it at the beginning? And the other question is investors. Basically, do we have misaligned incentives because the investors, particularly venture and private equity, have very large ROI expectations? And is that a mismatch? So I'll answer the first one and then I'll move to the second one. So first, how can we provide a superior product that costs the same as everyone else? We're giving richer benefits and a better user experience, but we're not charging them more than the other legacy insurers that we call the BUCAs. Key to that behind the scenes is 3 things. One, to your point, we're virtual, but we're a software company. So we've wherever possible, we've eliminated administrative burden by letting computers and software do what they do best, right? So that has reaped huge efficiencies behind the scenes. Allows us to do everything from general administrative tasks like accounting to more auto adjudication of claims processing. For instance, we don't need to know if someone did aspirin. An aspirin can be auto adjudicated. It's a simplistic example, but we also use the software to handle a number of other things, some low-level care coordination items, and that allows us to save a good chunk of money on the back end. The other thing, the second thing that allows us to save a lot of money is that unlike a lot of other companies that jumped into the market and rented networks, we built our own medical network, which as of today, I think is somewhere on the order of 76,000 medical providers in Texas. And that took us a long time to build. It was a very large investment. But because we own our own medical network and we built those relationships directly with the physicians and doctors, that gives us some cost benefits, but also medical quality benefits. We're trying to work with people that share our long-term vision. So that has some savings to it, right? And the third place that we kind of pick up at savings behind the scenes that we're able to push through to our members by trying to keep prices consistent is what we'd call shifts in utilization. And that's a nice way of saying, take care of people wherever possible sooner and at a more appropriate site or type of service. So, and that only works because we have a health plan that, from a financial standpoint, encourages people not to defer care. We are encouraging people to consume care, like free office visits, free specialist visits, free telehealth, no deductible, right? But you also have to have the technology to back that up. And then we have nurses that help as care guides. You have to have all these things kind of working together, and we have a rewards plan. And when you have all that kind of working together, financial incentives, user experience, and a good health plan design, you've got a good chance to shift the population's usage to better times and sites of care. So a classic example is after 5 p.m., you got a sick kid, you're a first-time parent, you panic. You go to the ER. Congratulations. That's $5,000 to $10,000. And you're going to be sitting there for hours. So you have a miserable experience. Your kid has a miserable experience, and that was at least $5,000 of expense. Well, how can we address that? Well, what we want is, it's after 5 p.m., you can't get a hold of a doctor, but call. Hey, within 3 minutes, you're going to get a physician on the phone or a pediatrician if you're using our pediatric specialists. And they're going to tell you, hey, your kid just has a fever or whatever the case may be. Relax, right? Or they may say, look, this is serious. You need to get the emergency room right now, in which case it's appropriate. But a lot of times what happens when people get seen at preventative care for zero cost, they get the telehealth, is instead of going to something like an emergency room where they have a miserable experience, it's really expensive, they get a better experience and higher quality care by going and seeing the physician down the street 2 days later, and that costs between $200 and $500. So everybody wins. The larger population we care for didn't have to bear $5,000 expense. So that means there's more money to help with other things. The individual got seen quickly. The individual had a better experience. They weren't sitting in a waiting room next to a bunch of other sick people for hours. That's what we mean by shifts in utilization. So we have administrative savings because we use software very efficiently and data. We have medical network savings because we built our own medical network. And third, we have savings that occur through shifts in utilization, where we want people to get seen and we're encouraging care quickly. And that, long term, we think the shifts in utilization could be the most powerful trend in terms of driving down costs while improving quality. It's big, but it takes time to move a population, to get people to, hey, you take advantage of that virtual doctor. Hey, take advantage of all these free resources we have, because people have been trained to do other behaviors. And it takes time to train a population, sometimes even when it's in our own best interest, to change their behaviors. You asked me another question, which was, the return on investment for venture capital misaligned with the core needs of driving change in healthcare and running a health insurer. And I would argue it's a mixed answer. For late stage, yes. For early stage, no. When you're borrowing, or let's call it borrowing or you're accepting $2 million in venture capital for a seed stage, it's a small amount of money. And if the implied rate of return on that's quite high, it's de minimis in the long term scheme of things. If you're borrowing $500 million, though, at those expected venture capital rates of returns, that's very different. We did not take $500 million. We took $2 million in the beginning. Then we raised another $5 to $6 million in another round, and then we did some continuing funding from then on. But it was a very modest amount of capital. Behind the scenes, the major health insurers nationally, I'll give you a pause here. Nationally, major health insurers on a commercial book of business, so employer-sponsored health insurance, they're going to make 3 to 5% profit after tax. And I think this is another spot that people misconstrue or align health insurers needlessly. In general, health insurers are not giant profit machines. They make their money at scale. They have a lot of top line leverage when you're serving 400,000 or 1 million people. That's a very, very big book of business. And it's, at 3% after taxes, that's a lot of money. But they're serving gigantic populations. By federal law, 85% of the money they collect must be paid out to plan members for direct care and care expense and quality improvement initiatives. So the insurer, when you think about it, some of these big companies are living on 12 points. Assuming they have a 3% margin after tax, they're living on 12 points, and they're running extraordinarily complex data management, provider network management, analytics, government reporting, and claims payment, medical quality. I mean, the sheer sophistication of what they're doing is enormous, and they're doing it on 12 points. I mean, most other businesses out there have much higher profit margins and flexibility, which is just something to keep in mind. For us on the capital side, getting back to your question, are we misaligned currently? And the answer is no. That's one of the great reasons we accepted the offer to become wholly owned by Globe Life. Globe Life is about making tomorrow better. They're in the business of making generational promises, and they have permanent capital. So we got off of the venture capital hamster wheel quite early, and we're now have a permanent capital base backing us of roughly $25 billion. So it changes all of the math for us and allowed us to really focus on taking care of people for the long term. It was a great question, though. I would agree with you that for a lot of other businesses, the expectations of return on investment are challenging to reconcile with population health needs.
Well, thank you for...
Which I think you're going to see a lot of that coming home to roost. The chickens will proverbially come home to roost for a lot of Medicare Advantage plans that accepted huge amounts of private capital. And I think the returns on investment for that are going to decrease over time as, my hypothesis is that the quality bonuses and other rewards that were built into Medicare Advantage are going to be lowered over time by CMS and to drive the return on investment back down to where it needs to be, and the expense of administering the plan back down to where it needs to be. But yeah, the MA plans that took a bunch of money, I think they strategically have some challenges ahead of them.
That's fascinating. Well, Chris, this has been an extremely interesting overview. And for me, you filled in a lot of the blanks from Top Desk to today, and it's absolutely fascinating. So I appreciate very much your time and answering the few questions that I've had, and I think for our listeners, providing some real insight into the sort of financial dynamics of the health insurance industry. For those people who are in Texas listening to this, can they expect that you will be in their employer's portfolio at some time in the future?
It probably not. And the reason is because most people, it's just the statistics. Most people are working at smaller businesses, and we can't serve what is considered small group, which is less than 50 employees. That's a different regulated market. I didn't set up the rules. That's the way the rules are. So we can't serve right now individual marketplace. We can't serve small group employers. We can only serve large group employers. But if you're at a large group employer in Texas, then absolutely. Yeah. Reach out to your HR person or your broker of record and tell them you want to see every health in the mix for your renewal. And our partners will make sure that happens.
That's wonderful. That's wonderful. Well, Chris, again, thanks so much for your time. I appreciate it.
Thank you very much, Mark.
I'm Mark Good. You've been listening to my remarkable podcast. For more episodes like this, as well as premium content, visit my site, markgood.substack.com.
Humble.